estado del mercado actual ha estado hablando nuestra compañera Marta Iser con Ned Bell. Vamos a escuchar lo que nos decían el análisis de los mercados este viernes. Vamos a poner en los próximos minutos el foco en la inversión en empresas de pequeña y mediana capitalización. Y además lo vamos a hacer con una gestora australiana, con un gestor australiano de amplia trayectoria que nos va a acercar a las principales oportunidades de inversión en las small y medium caps y sobre todo interrogando un poco en cuáles son los sectores que presentan un mayor atractivo, si es un buen momento este año 2022 para invertir en este tipo de empresas y sobre todo cuál es la trayectoria y el track record del fondo que gestiona. Vamos a hablar con Ned Bell, es CEO y gestor principal del fondo UBAM Bell Global SMID Cap Equity, es fundador de la gestora australiana Bell Asset Management. Ned, thank you so much for having us a few minutes.
Thank you very much.
Ned, in 2021, last year, there was a lot of talk about small and medium-sized companies, if they were or not a good investment opportunity. But with the strong corrections that we've seen in US and Europe markets, are they a good opportunity investment for this year, 2022?
We do think they are a great investment now. So obviously they have been weak. They have pulled back with the rest of the market. But what's really compelling now is they are very inexpensive. So the asset class trades on a PE of about 14.5 times, which is a 40% discount to large cap growth. And it trades at about a 7% discount to the market as a whole. So we do think the valuation risk has come out of the asset class a lot. And the earnings so far are holding up pretty well.
Mm-hmm. And what about in coming years?
So in coming years, obviously there's macro uncertainty, but our strategy is only investing in developed markets. Most of the economic weakness we're seeing is more coming out of China. So thankfully, developed world small mid-cap stocks don't have as much risk to their revenue growth, which is important. So we still feel like there's good valuation opportunity. The other issue is obviously inflation, and inflation is impacting earnings, but it's probably impacting companies that are much more in the low margin area, which we don't invest in.
Mm-hmm. We will talk about inflation and its impact in small and medium-sized companies, but the new cycle of interest rates has begun in the US and in Europe. Well, we will see if it's in July or if it's September. 25 basic points, 50 basic points. We will see it. But this rise in rates makes corporate debt more expensive. But in the case of small, medium caps, these higher costs of debt can be assumed more painful. How do you see it?
So I think it's a great question, because companies' ability to absorb rising interest rates and absorb inflation simultaneously is a real challenge. So the asset class as a whole, the average net debt to EBITDA is around 1.9, so it's not too bad. Companies in small mid cap don't have as much leverage as you would expect. The types of companies we're investing in like half the leverage, so we don't have as much of that risk. But I think as the year plays out, we're definitely seeing more earnings risk by those two factors: rising interest rate risk and also rising inflation risk impacting margins. It's probably the rising interest rate issue is more problematic probably for much growthier companies. So companies that are trading on much higher PE multiples, the multiple compression that we've seen so far this year has probably still got a ways to play out.
And which advantages do you see in investment when we talk about small and medium-sized companies compared to large-sized companies?
So it's a good question. I think a couple of the key differentiators are the small mid-cap asset class didn't get ahead of itself pre-COVID. It didn't get hugely expensive. You didn't see all of the various passive investors and ETFs investing in that part of the market. So as the market is becoming more volatile, retail money is coming out. That's having far less of an impact on small mid-cap companies. So there's less short-term valuation risk. I think the other reason for looking at the asset class is it plays a growth role. So it's much more about organic growth. These companies that we look at, they have been able to grow revenue at, say, 10% per annum, earnings growth at 14% per annum, that growth trajectory is still looking pretty solid. Whereas the problem with the large cap growth stocks, like what we're seeing with Netflix and Facebook, the growth rates are flattening very materially after 2 years of strong growth post-COVID. So that same phenomenon is not happening as much in the small mid-cap part. And the one last point I'd make is that when you compare developed small mid-cap companies to emerging markets, it's a different asset class, but over 25 years, they've given you 5% additional, 5% extra returns versus emerging markets with materially less risk.
And have small and medium-sized companies muscle or capacity to send a part of all this impact to their consumers, as we see in large companies?
So in terms of pricing power, I think the pricing power is some companies, so what we would call quality companies, companies with great franchises, good, great brands. I mean, these are the companies that typically have that pricing power, but it is, you see a lot of divergence. So I think in the case of companies like industrial companies, they're having more problems passing on all of the respective inflationary pressures, whereas for example, some of the consumer type companies that we look at in the US and Europe have got a much greater ability to pass on that inflation. So, for example, this year, when we look at our companies, we own around 45 companies. The earnings revisions have essentially been flat in a period where there's been big earnings divergence. So that's telling us that the companies are being able to pass on a lot of the inflation they're experiencing.
In fact, we see this pricing power in luxury, for example, when we talk about it. You maintain an investment approach of quality at a reasonable price. Can you give us an example of this?
Sure. So from a portfolio perspective, the average return on equity of our portfolio is around 24%. And the average PE is around 18 times. So that's what we're trying to achieve at a portfolio level. At a stock level, a good example would be a US company called Yeti, which is it's an up-and-coming consumer company based in Texas. So they've been huge beneficiaries of COVID, the outdoors theme. So that's a stock which generates a 36% return on capital. It's growing its earnings around 12%. It's in a net cash position, and from a valuation perspective, it trades on a PE of about 15 times earnings. So that's very good value for money. I often refer to Yeti as the next Lululemon, or one of these brands that's got a long way to grow outside of North America.
And the fund you manage, it's the UBAM Bell Global SMID Cap Equity, has had a track record since 2016, and in 2021 it began to be marketed in Europe as a product aimed primarily at institutional investors. What weight should such a strategy have if we talk about a conservative investment portfolio, and what about if we talk about a riskier one?
So in terms of a more conservative, I mean, generally the way our investors look at the strategy within an equity portfolio per se is that the typical more conservative exposure is around probably 10%. The more the investors we talk to who are taking a more aggressive approach, it's more like 20% to 25% of their equity exposure. And we've seen that more recently, that investors have been moving away from large cap growth and emerging markets for slightly different reasons towards global small mid cap investing for the reasons we've touched on. And within this universe, in which sectors do you find now investment opportunities? So the types of sectors we have exposure to typically are sectors like consumer discretionary, consumer staples, IT and healthcare. Those are probably the four major sectors. I think where we're seeing the best valuation opportunities is probably in the consumer space.
Okay.
So there's a lot of consumer stocks globally, but particularly in the US, have been very oversold relative to earnings. So, for example, our US consumer companies, the earnings revisions have been going up. They're up 4%, yet the stocks are down 25%. So that's an example where we see some real disconnects in the market, great opportunities for active investors to buy stocks that are temporarily out of favour but will compound earnings very strongly.
Mm-hmm. And the fund invests in companies from developed countries. Within this, do you have a preference about one?
So we tend to be, or the bulk of the exposure is in North America and Europe, less so in Asia Pacific. We've been very overweight Europe for the last probably 3 to 6 months. So we've been taking profit in North America for 2 years and reallocating into European companies. So we are overweight in Europe by about 12%. Within Europe, we tend to have more exposure to the UK, Scandinavian markets and Swiss markets, particularly Denmark. We actually have 5 companies. We tend to find very high return on capital businesses in Denmark. So we actually have 5 Danish companies that have got I think an average return on capital of around 20%.
And in terms of volatility, this fund has a volatility of 14%. This is not suitable for all herds, but should investors assume that in order to obtain results that manage to beat inflation, they have to assume this high volatility?
I think essentially yes, and it depends. It obviously depends on the type of investor and their risk tolerance. But I do think that when we think about volatility, 14% relative to the broader equity market is not as bad. So I think if you are going to try and, I mean, now inflation is obviously the big question we're all asking ourselves, and to some degree, I think investors are put into a position where they need to take some risk. So it then comes down to where should I be taking risk within the equity, the broad equity framework, and I think for all the reasons I've touched on, being less valuation risk, there's less crowding and probably better earnings growth. The small mid-cap part of the market is very interesting. It doesn't have as much representation in portfolios and great scope, I think, to also outperform in the next few years.
And let's talk about sustainability, ESG. How is the application of these filters in these medium and small sized companies? In the case of these enterprises, these companies, I assume that it's more difficult to apply these filters, these ESG criteria, yes. But I don't know if I am wrong or not. How do you say it?
Yeah, it's a really good question. So we do have, this is an ESG integrated approach, and always has been. So our approach is, it's more of an integrated, pragmatic approach to ESG. So we screen out some well-known sectors like in weapons, tobacco, cluster munitions, those sorts of things. But we also take we form an opinion on the ESG risks that face each of those companies. And while there are a lot of companies that fail, there's also some companies that really excel. And what we tend to find is clearly European companies are above the world average when it comes to ESG. The US is playing catch up, but they are catching up like a lot more so than what we've seen in previous years. So as much as there are a lot of poor quality companies from an ESG perspective, there's also some excellent ones. When we think about our strategy, for example, the carbon footprint of our strategy is 88% lower than the benchmark. And we do tend to find companies probably more in the mid-cap area where they're a little bit more mature from an ESG perspective, so they can be found, but you need to be selective.
And do you feel more pressure to apply this criteria? I don't know if it's there is pressure from investors, institutional investors, I assume.
So we've always had ESG integration into our approach. So that's always been there for us. So we've never felt pressured to implement ESG criteria into our approach. We've always felt that you can strike the balance between having good ESG outcomes without compromising on returns, and that's the big question that every investor is asking themselves. We think the way that we do it, you can do it, and I think we feel very well aligned with the trajectory of how the asset allocators are moving. So it's something we're very comfortable with, and we feel like you can implement it if you do it the right way.
Ned Bell from Bell Asset Management, thank you so much for being here. It's been a pleasure.
Pleasure. Thank you.
Nosotros nos quedamos con estos mensajes. Inversión, como decimos, en small y medium caps, en pequeñas y medianas empresas de capitalización, sobre todo con el foco puesto en el consumo, uno de los sectores ahora mismo pujantes dentro de esta oportunidad de inversión. Y ya vemos que los criterios ESG también se aplican en este caso, con presión, por supuesto, por parte de las gestoras para cumplir esos criterios, y viendo cómo el viejo continente en este sentido es el que más avanzado está en estos términos.